Discounting future cash flows. The Warren Buffett, Charlie Munger approach. Links in the description. Warren Buffett. In a world of 7% long-term bond rates, we'd certainly want to think we were discounting the after-tax stream of cash at a rate of at least 10%. But that will depend on the certainty that we feel about the business. The more certain we feel about the business, the closer we're willing to play. We have to feel pretty certain about anything before we're even interested at all. But there are still degrees of certainty. If we thought we were getting a stream of cash over the 30 years that we felt extremely certain about, we'd use a discount rate that would be somewhat less than if it were one where we expected surprises or where we thought there were a greater possibility of surprises. We basically think in terms of the long-term government rate. And there may be times when because we don't think we're any good at predicting interest rates, but probably in times of what would seem like very low rates, we might use a little higher rate. But we don't put the risk factor in, per se, because essentially, the purity of the idea is that you're discounting future cash. And it doesn't make any difference whether cash comes from a risky business or a safe business, so-called safe business. So, the value of the cash delivered by a water company, which is going to be around for 100 years, is not different than the value of the cash derived from some high-tech company, if any, that you might be looking at. You better just stick with businesses that you can understand, use the government bond rate. And when you can buy them, something you understand well, at a significant discount, then you should start getting excited.